Right now, PUIC is trading at $7.09, which is down about 66% from its 52-week high.
Yeah.
But here is the catalyst that makes this so insane. They're posting a trailing 12-month revenue growth of almost 458%.
Right, which is massive.
Yeah.
But then, in the exact same breath, their net margin is sitting at negative 6,493%.
Which just, it sounds like a math error waiting to bankrupt a business.
It really does. It looks like a typo in the filings.
It totally does. Well, welcome to Market Pulse Daily, everyone. Today we are looking at a wild, high-stakes player in the AI infrastructure space.
Because there is a massive physical bottleneck happening in AI right now, and POET might actually be the key to fixing it.
Exactly. But before we get into this whole bandwidth wall thing, I want to quickly mention StockOracle.
Oh, yeah. Great tool.
Right. So StockOracle is an AI-aided stock research platform, and it is honestly great for things like fundamentals, valuation estimates, moat analysis, bull and bear insights.
So they do comparisons, watch lists, portfolio research, all that stuff.
Yeah, we have a special 14-day trial link below in the description. Just a heads up, it is an affiliate link, so the channel might earn a commission at no extra cost to you.
And, of course, we always have to remind you that StockOracle is not financial advice. It's, not a buy or sell recommendation or a trading signal service, and it doesn't provide real-time market data.
Right. Super important. AI insights and valuation estimates can be incomplete or just outright wrong sometimes.
Yeah.
The data can be delayed, so always verify the important facts yourself.
Yep. Do your own homework.
Always. Okay, so let's get into POET.
Yeah.
If you're an investor, a tech person, or just curious about how AI actually works on a physical level, this is huge.
Because we hear so much about the software, right? ChatGPT, large language models.
Yeah, the algorithms.
Right, but none of that actually matters if the physical machines can't handle the data load. So to understand POET's value, you have to understand the physical wall the whole AI industry is crashing into right now.
The bandwidth wall.
Exactly. Engineers call it the bandwidth wall. Because right now, data centers, these giant warehouse-sized buildings full of servers, they are mostly wired together using standard copper interconnects.
Copper wiring. Literally the exact same stuff conducting electricity in our houses.
The very same. And, copper has been perfectly fine for normal computing for decades.
Sure.
But AI requires moving these unimaginably massive data sets between processors at lightning speed. And when you push that much electrical current through a tiny piece of copper, you get physical resistance.
And resistance creates heat.
A ton of heat, and heat destroys microchips. So to stop the chips from literally melting, data centers have to pump incredible amounts of electricity into these massive cooling systems.
Which I imagine costs an absolute fortune.
Oh, it's incredibly expensive. And on top of the cost, copper physically degrades the electrical signal over distance. You literally just can't push the data fast enough for these new AI processors without the signal falling apart.
So the copper is quite literally choking the processing power of the best chips in the world.
Exactly.
Okay, let's unpack this for a second, because I feel like a lot of people just nod along when they hear bandwidth without actually getting the physical reality of it.
Right.
It's like, okay, using copper is like trying to ship millions of packages using physical delivery trucks on a crowded, sweltering highway.
That's a good way to look at it.
Right. Eventually, the engines overheat, the highway gets jammed, and traffic just grinds to a halt. You can't just build a slightly bigger truck to fix it.
No, you need a totally new mode of transportation.
Exactly.
Yeah.
And what POET is doing is essentially taking those packages and teleporting them with lasers.
Lasers, yes. You are literally changing the state of the data.
It's not a wider highway, it's just different physics.
Completely different physics. So POET's primary fundamental catalyst, their main moat, is their intellectual property in something called silicon photonics and optical interposers.
Okay, wait, hold on. Optical interposer is a very heavy piece of jargon.
Fair enough.
What actually is an interposer mechanically, and how is it different from just a normal microchip?
So an interposer is basically a physical bridge. In a normal computer, you have different chips, like, say, your memory chip and your processor, and they have to talk to each other.
Right.
Usually, they sit on a circuit board and communicate through electrical signals over copper traces, but an interposer sits directly underneath or between those chips, acting as this hyper-fast, highly concentrated bridge.
Okay, got it.
And what POET does is build that bridge out of specialized glass. So instead of sending electricity across the bridge, they convert the data into light photons and just shoot it through the glass.
So they're replacing the electrical truck bridge with a fiber optic laser bridge.
Exactly. And the benefits are just staggering. Light moves faster, it generates almost zero heat, and you get massively more bandwidth.
So you solve the heat problem and the speed problem at the same time.
Right. And what's really fascinating here is how this creates incredibly high switching costs for POET's customers.
What do you mean?
Well, this isn't just selling a better USB cable that a customer can just unplug later if they find a cheaper one. POET's optical chips are designed directly into the next generation AI infrastructure racks by these massive hyperscalers.
The giants actually running the data centers.
Yes. So the laser bridge is baked into the physical architecture of a multi-billion-dollar server rack.
Oh, wow.
Once a hyperscaler designs their infrastructure around POET's specific glass hardware, it becomes prohibitively difficult and disruptive and expensive to rip all that out just to switch to a competitor.
So the moat is incredibly deep because you are integrated at the absolute base hardware level.
Precisely.
Which sounds like an absolute dream scenario for a tech company, right? You hold the key to solving the biggest physical bottleneck in the biggest growth industry on Earth.
It's a very strong position to be in.
But that brings us right back to those Jekyll and Hyde financials we talked about at the start.
Ah, yes, the margin issue.
Yeah, because if you're listening to this and thinking, wow, this tech is revolutionary, then why on earth are their net margins sitting at a catastrophic negative 6,493%?
It looks terrifying.
It really does.
Yeah.
If the tech is so essential, why are they bleeding out like this?
I'll grant you it's top-line shock value. But we have to look past that and break down the actual unit economics in the data.
Okay.
That negative 6,400% net margin and their earnings per share being negative 74 cents, that is actually very typical for a hardware company transitioning from research and development into commercialization.
But I mean, a negative margin that deep means they're spending a staggering amount of money just to keep the lights on today.
They are.
So how does that ever translate into a sustainable business?
You find the answer by looking at a completely different metric in the research, which is their gross margin. Over the trailing 12 months, their gross margin is sitting at a very solid 51.79%.
Okay, so explain how those two interact. How do you have a positive 52% gross margin, but a negative 6,400% net margin?
Because gross margin only looks at the direct cost to produce the specific goods they are currently selling right now.
Oh, okay.
So a nearly 52% gross margin proves that the underlying unit economics of the optical chips themselves are incredibly strong. It basically costs them roughly 50 cents in materials and labor to make a dollar's worth of product.
That's a great margin.
It is, but the net margin factors in all the massive fixed costs. The years of R&D, the legal fees for patents, and most importantly, building out the factories.
Maybe the overhead.
Once they hit massive manufacturing scale, the volume of high-profit sales will catch up, absorb all those fixed costs, and that negative net margin will violently reverse.
Okay, I hear you, but gross margins on a spreadsheet don't pay the rent today. You can't just run on empty while you wait for massive orders to roll in next year.
That's true.
A company bleeding cash like that should be on the verge of bankruptcy. So how are they actually surviving right now?
Well, the research describes POET's balance sheet right now as explicitly cash-rich, which is super rare for a company in this phase.
Cash?
Yeah, they recently completed a huge financial move. They did an $830 million capital raise.
Wait, over 800 million.
Over $830 million.
That is a massive war chest for a company of this size.
It provides them with a very, very deep liquidity runway. And the plan is to use a chunk of this cash to aggressively fund a $50 million manufacturing expansion.
Just to scale up the optical chip capacity.
Exactly, to meet the hyperscaler demand. And crucially, because they raised this capital successfully, they are doing this without relying on high-interest dilutive debt that would just crush their future earnings.
But throwing cash at an empty room doesn't guarantee sales,
No, it doesn't.
You can build the most advanced factory in the world, but if the timelines don't line up, you are just burning that $830 million paying salaries.
Right.
So why does it take so long? Like, when do these laser bridges actually start shipping in volume?
Well, hardware manufacturing is just incredibly complex. You are dealing with nanoscale precision, entirely dust-free, clean rooms, highly specialized machinery.
You don't just flip a switch.
You really don't.
Yeah.
But management's forward-looking guidance points to a highly specific inflection point, which is the H2 2026 production ramp.
Second half of 2026.
Yes, that is when this massive manufacturing capacity is actually slated to meet the commercial rollout. That is the moment they aim to flip from a cash-burning R&D story into a cash-generating commercial reality.
Okay, let me stop you there, because we really need to address the reality of the market sentiment right now.
Sure.
We have a company with essential AI tech, an $830 million war chest, and a clear target for a massive production ramp in 2026.
Sounds great on paper.
It sounds incredibly bullish. So why has the stock been completely pummeled? If this is the future, the technical picture here is an absolute bloodbath.
The public market is notoriously impatient. Hardware timelines of 2 or 3 years are just way beyond the attention span of your average retail investor.
Let's lay out just how impatient they are. Looking at the market data, like I said earlier, the stock is at $7.09. That's down almost 66% from the high.
Yeah.
And the valuation reset is severe. The price-to-book ratio, the PB ratio, is currently sitting at just 2.63.
And to put that PB ratio in context, it's sitting roughly 68% below its long-term median.
Let's actually pause and explain what a price-to-book ratio measures for the listener, just because it really highlights the market's pessimism here.
Yeah, good idea.
The book value is essentially what the company would be worth if you shut the doors today, sold off all the factory equipment, the intellectual property, the office desks, and paid off all the debts.
It's the literal liquidation value.
Right, so a PB of 2.63 being that far below its historical norm tells us that the broader market is pricing POET almost entirely based on its scrap value, rather than its potential to dominate AI hardware.
They are pricing it like a company with no future.
Exactly.
But if we connect this to the bigger picture, this is where we see a classic bullish divergence in the data.
Okay, how so?
When you look at the trading data, the volume regime currently sits at just 0.4 times the 10-day and 3-month average.
Okay, hold on. Volume regime is total Wall Street jargon.
Fair, fair.
Are you basically just saying people have stopped panic selling?
Effectively, yes. The volume of shares being traded has just plummeted. The sell-off is exhausting itself. The retail investors who bought at the top and couldn't stomach the drop, they've already sold.
Right, they're gone.
But while retail has been panicking, the institutional heavyweights, the smart money, are quietly building stakes in the open market.
Really?
Yeah. They are looking at the compressed valuation, the $830 million cash pile, and that 2026 production ramp, and they are just accumulating shares under the radar.
I mean, it's the oldest dynamic in the market. The retail crowd gets tired of waiting and sells at the absolute bottom, while the institutions quietly swoop in and buy the discount.
Exactly.
And we're actually already seeing the sentiment start to shift in the data. Despite the massive sell-off, the research shows POET was recently upgraded by analysts to a strong buy.
Which is a huge signal.
It is. So, if the smart money is quietly accumulating shares today, what are they waiting for? Institutions don't just park money for 2 years without expecting catalysts along the way.
No, they don't.
What could actually send the stock higher in the near term before we even get to 2026?
Well, the analyst consensus right now is frankly astonishing. When you aggregate the price targets from the data, the 12-month average target is $17.50.
Wow. From roughly $7 today, a target of $17.50 implies nearly a 99% upside.
And some analyst predictions in the research estimate up to 160% upside as AI demand accelerates.
That's massive.
It is. They are anticipating several macro and sector-specific tailwinds over the next few months. First, there's just the rising tide of the entire semiconductor sector, mostly driven by the anticipation of NVIDIA's earnings.
Right. Strong earnings from the leader lift all the boats in the AI hardware space.
Exactly. It provides a natural sympathy bid for optical plays like POET.
There's also a major macroeconomic overhang that was just removed, which gives the whole sector some breathing room. According to the research, former President Trump has delayed the 50% EU tariffs until July.
Which is huge.
Now, obviously, setting aside all the politics of trade wars, purely from a supply chain perspective, why does an AI hardware company care about European tariffs?
Because hardware relies on highly complex global supply chains. The raw materials, the manufacturing equipment, the specialized glass, these components cross borders multiple times before a finished chip is assembled.
Right, it's not all made in one building.
Not at all. Heavy tariffs freeze supply chains because companies suddenly have to reevaluate their entire cost structure.
Yeah.
So delaying those tariffs removes a massive short-term hurdle.
It provides predictability.
Exactly. Predictability for a company currently trying to execute a $50 million manufacturing expansion.
Predictability is great, but macro tailwinds only get you so far. Here's where it gets really interesting in terms of market sentiment.
The rumor.
The rumors. The rumor mill is churning hard. There are unconfirmed rumors circulating of a landmark supply agreement that could just fundamentally reshape their timeline.
Yeah, the data notes intense speculation about a potential direct design win with a Tier 1 hyperscaler.
Like who?
Names like NVIDIA or Amazon Web Services are being floated in these unconfirmed whispers.
I mean, if a giant like Amazon officially signs a contract to use Poetes optical interposers, that validates the technology instantly to the entire world.
Overnight, it changes the narrative from pre-revenue promise to commercial reality.
It would be the ultimate validation of their technological moat. Suddenly, they aren't just a research lab. They are a critical vendor to the largest tech companies on Earth.
True. But, and we have to be incredibly careful here, it is crucial to remember that these are currently unconfirmed rumors.
Very true.
An investment thesis built entirely on a rumor is a very, very fragile thing.
Which is the perfect reason to bring us back down to earth and look at the pros versus the cons.
Let's do it.
Because a 99% to 160% projected upside sounds incredible, but we have to look at the downside. If you were listening and thinking this sounds too good to be true, you are right to be skeptical.
Always be skeptical.
Why might this whole thesis fall apart? What is the bear case?
There are two very glaring red flags on the corporate governance side. The company is currently facing class action lawsuits, and there was a very recent significant CEO exit.
A CEO abruptly leaving, combined with class action lawsuits.
Yeah.
I mean, that is usually enough to send any sane investor running for the hills.
It's classic management turmoil.
It really is.
It is deeply concerning, without a doubt. Leadership instability during a critical transition to commercial manufacturing is dangerous.
Yeah.
However, purely from a market pricing perspective, we have to ask if the damage is already done.
Meaning?
These risks are likely largely priced into that massive 60% drawdown we discussed and reflected in those trough price-to-book levels. The market is fully aware of the lawsuits and the CEO exit and has already punished the stock accordingly.
So the bad news is already baked into that $7 price tag.
Basically, yes.
But that raises an important question. What isn't priced in? If the lawsuits aren't the real danger, what is the actual existential threat to this company?
The existential risk all comes back to execution and the timeline. That H2 2026 production ramp is the absolute lifeline.
Right.
We know they are braining cash at an extreme rate right now. Yes, they have the $830 million raise, which provides a solid runway. But as we discussed, hardware manufacturing at this scale is notoriously difficult.
Things go wrong.
Things go wrong, supply chains snag, yield rates on new chips can be abysmal at first.
And the cash blend doesn't stop just because the factory is delayed. You're still paying everyone.
Precisely. Any significant delay in that manufacturing timeline severely compresses their runway to profitability. If that 2026 ramp gets pushed to, say, late 2027 or 2028, they will burn through that $830 million before they can turn on the revenue spigot.
And if that happens, they have to raise more capital.
And at that point, they would likely have to rely on highly dilutive debt, which destroys shareholder value. So execution risk on the manufacturing floor is the single biggest threat to this bullish thesis.
Okay, so we've looked at the blindingly fast revenue growth, the terrifying net margins, the physics of the copper bandwidth wall, the smart money accumulation, and obviously the very real execution risks of building a factory.
We've covered a lot.
We have. So what is the final outlook? What does the data say as we wrap up today?
If we synthesize all the data from the research into a final evaluation, it comes down to this.
Okay.
Based on the metrics, PUT earns a bullish score of 8 out of 10.
An 8 out of 10 despite the massive drawdown and the management turmoil.
Yes, because the fundamentals of the technology and the balance sheet outweigh the short-term noise. The data suggests it is a severely oversold, cash-rich AI optical play.
Right, trading near trough valuation levels despite posting revenue growth of over 450%.
Exactly. You have institutional heavyweights accumulating shares ahead of a critical 2026 production ramp and analysts projecting massive upside.
It's a highly asymmetric risk-reward profile.
It is. But, and this is vital for anyone looking at this space, the data points to this being a multi-year hold. This is an 18 to 24-month horizon play to capture that 2026 commercialization phase.
It is not a quick flip for next week.
Definitely not.
You have to be willing to ride out the volatility, ignore the rumors, and trust that they can execute on their manufacturing timeline. That execution is the key risk here.
Absolutely.
Well, it's a fascinating look under the hood of the AI boom. And if you want to run these numbers yourself or check out other tech plays, don't forget to hit the subscribe button and check out Stock Oracle.
Right. The special 14-day trial link is in the description. Again, it is an AI-aided platform for fundamentals, valuations, and portfolio research.
Just remember, it's an affiliate link, so we might earn a commission.
Yeah.
And as always, verify the facts because AI can be wrong and it is not financial advice. All right, I want to leave you with one final thought to ponder as we close out. We constantly hear about the software side of AI. You know, the algorithms, the data sets, the sheer intelligence of the models getting smarter every single day.
It's all anyone talks about.
Right. But if companies like POET fail to overcome the physical bandwidth wall of copper wiring, will the entire AI revolution just grind to a halt?
Wow.
Not because the code isn't smart enough, but because our physical infrastructure literally can't carry the data fast enough.
It's a scary thought.
Are we vastly underestimating the sheer physical limits of the AI boom? Think about that the next time you ask an AI a question. We'll catch you next time on Market Pulse Daily.